International financial environment. The international financial environment refers to the economic and financial conditions that exist in the global marketplace. It is important for businesses to understand the international financial environment because it can have a significant impact on their operations and profitability. Here are some important topics related to the international financial environment. Importance of international finance. International finance is important for businesses because it allows them to expand their operations globally, access new markets, and diversify their sources of revenue. By engaging in international finance, businesses can take advantage of new opportunities and reduce their exposure to risks in their domestic markets. Rewards and risks of international finance. International finance offers many rewards, such as increased revenue, access to new markets, and diversification of risk. However, it also poses many risks, such as currency fluctuations, political instability, and regulatory changes. Businesses need to carefully evaluate the rewards and risks of international finance before engaging in it. Goals of multinational corporations (MNCs). Multinational corporations (MNCs) have several goals when engaging in international finance. These goals include maximizing profits, minimizing risks, and expanding their operations globally. MNCs also aim to establish a competitive advantage in the global marketplace and to create value for their shareholders. International business methods. There are several methods that businesses can use to engage in international business. These methods include exporting, licensing, franchising, joint ventures, and foreign direct investment. Each method has its own advantages and disadvantages, and businesses need to carefully evaluate which method is best suited for their needs. Balance of payments. The balance of payments (BOP) is a record of all economic transactions between a country and the rest of the world. It is important for businesses to understand the BOP because it can have a significant impact on their operations and profitability. Fundamentals of BOP. The BOP is divided into two main components, the current account and the capital account. The current account records all transactions related to the import and export of goods and services, while the capital account records all transactions related to the movement of capital. Accounting components of BOP. The accounting components of the BOP include the current account balance, the capital account balance, and the overall balance of payments. The current account balance is the difference between a country's exports and imports of goods and services, while the capital account balance is the difference between a country's inflows and outflows of capital. Equilibrium and disequilibrium. The BOP is said to be in equilibrium when the current account balance and the capital account balance are equal. When the BOP is in equilibrium, there is no net movement of capital between countries. However, when the BOP is in disequilibrium, there is a net movement of capital between countries, which can lead to currency fluctuations and other economic problems. International monetary system. The international monetary system refers to the system of exchange rates and international payments that exist between countries. There have been several different international monetary systems throughout history, including the gold standard, the Bretton Woods system, the flexible exchange rate regime, and the current exchange rate arrangements. The Economic and Monetary Union (EMU) is another example of an international monetary system. International monetary system. The international monetary system refers to the system of exchange rates and international payments that exist between countries. Over time, the international monetary system has evolved, and several different systems have been implemented. Here are some of the most important systems in the history of the international monetary system. Gold standard. The gold standard was a monetary system that was used from the late 19th century until the early 20th century. Under the gold standard, currencies were directly tied to gold, and the exchange rate between currencies was determined by their relative gold content. The gold standard was abandoned during World War I due to the high costs of the war. Bretton Woods system. The Bretton Woods system was implemented after World War II and was in place from 1944 until 1971. Under the Bretton Woods system, exchange rates between the currencies of all countries belonging to the International Monetary Fund (IMF) were fixed. The US dollar was the key currency, and all other currencies were pegged to the US dollar. The US dollar was also convertible to gold at a fixed exchange rate of $35 per ounce. Flexible exchange rate regime. The flexible exchange rate regime was implemented after the collapse of the Bretton Woods system in 1971. Under the flexible exchange rate regime, exchange rates between currencies are determined by market forces such as supply and demand. The flexible exchange rate regime allows for greater flexibility in the exchange rate system and can help to reduce currency volatility. Current exchange rate arrangements. The current exchange rate arrangements are a mix of fixed and flexible exchange rates. Some countries still use fixed exchange rates, while others use floating exchange rates. Some countries also use a managed float system, where the exchange rate is allowed to fluctuate within a certain range. Economic and Monetary Union (EMU). The Economic and Monetary Union (EMU) is a monetary union that was established in 1999. The EMU consists of 19 European Union countries that have adopted the euro as their currency. Under the EMU, the European Central Bank (ECB) is responsible for setting monetary policy for the Eurozone. In conclusion, the international monetary system has evolved over time, and several different systems have been implemented. Each system has its own advantages and disadvantages, and businesses need to carefully evaluate the risks and rewards of engaging in international finance under each system. By understanding the evolution of the international monetary system, businesses can make informed decisions about engaging in international finance and expanding their operations globally. What are the advantages and disadvantages of the gold standard and the Bretton Woods system? Advantages and disadvantages of the gold standard. Advantages: price stability. The gold standard provides price stability by making it harder for governments to inflate prices by expanding the money supply. Long-term stability. The gold standard provides long-term stability by reducing the risk of currency fluctuations and reducing the risk of inflation. Confidence. The gold standard provides confidence in the global financial system by providing a stable and reliable store of value. Disadvantages: imbalance. The gold standard can cause an imbalance between countries that participate in the gold standard. Gold-producing nations may be at an advantage over those that don't produce the precious metal, thereby increasing their reserves. Economic recessions. The gold standard may prevent the mitigation of economic recessions because it hinders the ability of a government to increase its money supply, which is a tool many central banks have to help boost economic growth. Advantages and disadvantages of the Bretton Woods system. Advantages: stability. The Bretton Woods system provided a stable international monetary system that helped to promote economic growth and stability in the post-World War II period. The fixed exchange rates and the role of the US dollar as the dominant reserve currency helped to reduce currency volatility and promote confidence in the global financial system. International cooperation. The Bretton Woods system encouraged international cooperation and coordination among countries, which helped to promote economic growth and stability. Disadvantages: US dominance. The Bretton Woods system was heavily reliant on the US dollar, which meant that the US had a disproportionate amount of power and influence in the global financial system. Inflexibility. The Bretton Woods system was inflexible and did not allow for adjustments in exchange rates to reflect changing economic conditions. Unsustainable. The Bretton Woods system was unsustainable in the long run because it relied on the US to maintain a fixed exchange rate between the US dollar and gold, which was not feasible given the US's large trade deficits and the increasing demand for gold. How did the gold standard and the Bretton Woods system impact international trade relations? The gold standard and the Bretton Woods system had significant impacts on international trade relations. Here are some of the ways in which these systems impacted international trade relations. Gold standard. The gold standard provided price stability by making it harder for governments to inflate prices by expanding the money supply. The gold standard reduced the risk of currency fluctuations and reduced the risk of inflation. The gold standard provided confidence in the global financial system by providing a stable and reliable store of value. The gold standard caused an imbalance between countries that participated in the gold standard. Gold-producing nations may have been at an advantage over those that did not produce the precious metal, thereby increasing their reserves. The gold standard may have prevented the mitigation of economic recessions because it hindered the ability of a government to increase its money supply, which is a tool many central banks have to help boost economic growth. Bretton Woods system. The Bretton Woods system provided a stable international monetary system that helped to promote economic growth and stability in the post-World War II period. The Bretton Woods system reduced currency volatility and promoted confidence in the global financial system. The Bretton Woods system encouraged international cooperation and coordination among countries, which helped to promote economic growth and stability. The Bretton Woods system was heavily reliant on the US dollar, which meant that the US had a disproportionate amount of power and influence in the global financial system. The Bretton Woods system was inflexible and did not allow for adjustments in exchange rates to reflect changing economic conditions. The Bretton Woods system was unsustainable in the long run because it relied on the US to maintain a fixed exchange rate between the US dollar and gold, which was not feasible given the US's large trade deficits and the increasing demand for gold. In conclusion, the gold standard and the Bretton Woods system had significant impacts on international trade relations. While both systems provided stability and reduced currency volatility, they also had their drawbacks, such as causing an imbalance between countries and being unsustainable in the long run. By understanding the impacts of these systems on international trade relations, businesses can make informed decisions about engaging in international finance and expanding their operations globally.